Stocks are flirting with record highs and consumers are making a comeback in terms of spending. So where are the opportunities in stocks right now? Eric Wiegand is the Senior Portfolio Manager at U.S. Bank Wealth Management and joins me now on set. And Eric, yesterday we had pretty strong consumer spending data. So does this give retailers a better opportunity to capture consumer spending? What's your take on the rest of the year in terms of the retail sector?
Well, it's certainly reassuring. Consumers had largely gone into hibernation, not only because of the weakness that we had seen in the first quarter, but it had actually spilled early into the second quarter. So renewed confidence, growth in wages, and obviously retail sales finally ticking up is certainly encouraging. From a retailer's standpoint, this is encouraging. What will be something to focus on will be if we continue to see a rise in energy prices as we move throughout the remainder of the year.
Because retail stocks, at least lately, have been quite erratic, right?
No doubt about it. And it really has been, not only sector, but also company specific. And
going forward, do you think the retail sector might see a rebound?
We do, but it'll be very important to choose your points. The consumer is feeling healthier, but we've also seen more of a predisposition as far as the consumer to buy more durable types of goods. Home sales have increased, and auto sales have actually been pushing higher.
All right, let's switch gears and talk about technology. What's your take on that sector? Of course, the big news is Twitter's CEO stepping down on July 1st. Of course, Twitter has struggled with growth. What do you think about the tech sector?
Tech sector is certainly going to, to follow the strength in capital spending, and that has also been a little erratic. If companies get more confidence and if we continue to see some wage pressure, all of a sudden the attractiveness of technology and replacing labor becomes certainly more important and more compelling.
All right, and sectors you're trying to stay away from in this market?
Sectors we're trying to stay away from in this market would be, much more defensive or interest rate sensitive. Things like utilities and telecom would be areas that we would look to avoid. Energy and materials, while we think there could be some opportunity, likely strength in the dollar has us away from more of the commodity-oriented space.
And of course, some of those sectors are very capital intensive, so higher rates would increase their borrowing costs.
There's no doubt about it, which causes us to actually like things like financials. We think there's opportunity there as we move through the remainder of the year.
All right, well, let's also talk about the bond market. That, of course, plays into higher rates. We're seeing yields on the 10-year, the benchmark yields, at about 2.36% compared to about 2.12% earlier in the year. What's your take on bonds, especially as we look towards the Fed's rate hike?
I think you really hit on it. It's going to be more volatile. That 10-year has experienced more pressure on prices as a result of weakness, particularly among the German Bund, as we've seen those rates go from 5 basis points out to 105. So we actually do think that we will see interest rates continue to rise, but there will be perhaps a little bit more volatility along the way and even on the front end as we approach the Fed moving away from its zero interest rate policies.
So maybe avoid bonds and stay in stocks?
We haven't seen that yet. It's been very interesting that, the money flows just haven't corroborated that. Individual investors are still staying with bonds. We do think that there likely will be some shakeout there as we see rates push higher.
All right, Eric Wiegand, we'll leave it there. Thanks very much for coming in.
Thank you for having me.
I'm Scott Gamm, and you're watching The Street.